In this presentation, we'll take a look at accounting methods with relation to sole proprietorships reporting income on the Schedule C. Remember, we're focusing up top in terms of our income tax equation on the income line, recalling that this is going to be supported by a Schedule C, which will have income and expenses, income and deductions, in other words, that will then flow forward to the first page of the 1040, representing this tax equation to the income section. Within the 1040, we're focusing in on this number on the first page of the 1040 for the income section, 100,000, it being supported by the Schedule 1, it being supported by the Schedule C. So accounting methods. An accounting method is a set of rules used to determine when and how income expenses are reported. Your accounting method includes not only the overall method of accounting you use, but also the accounting treatment you use for any material item. You choose an accounting method for your business when you file your first income tax return that includes a Schedule C for the business. After that, if you want to change your accounting method, you generally must get IRS approval. So in other words, you have some flexibility with the accounting method with regards to the Schedule C business. However, once you've already assigned an accounting method, the IRS wants consistency, because if you were able to switch the accounting method as you go through, you would be able to basically adjust the timing of it and manipulate your income. So the IRS gives you flexibility. You have some options with the accounting method. Just make sure that the one you pick is the one you stick with. If you need to make a one-time change in the future, then you need to seek IRS approval in order to make that change. As long as that change is for, legitimate purposes, then they would probably approve the change. But what they don't want to see is the method to be changing year over year for no other reasons other than possibly to lower taxes. Kinds of methods. Generally, you can use any of the following accounting methods. We have a cash method. We have the accrual method. These are the two kind of points, and most times we think about these two methods as if they're opposites, like they're not. You can't mix the two. But you do also have a special methods accounting for certain items of income expenses and a combination method using elements of two or more of the above. And in other words, especially if you use a cash method, you almost always are not using just a cash method, because some things are going to apply accrual concepts, such as if you were to purchase like equipment. So really there's kind of a spectrum that is happening here, generally between a cash method, full cash method on one side, full accrual method on the other side. And then you could have some variation basically between them. Again, the IRS basically wanting consistency once a method has been applied. That's what they're looking for. So, and there could be rules in terms of when you must use an accrual method as well. Note that the accrual method is kind of the more official or correct method to use typically, because you can manipulate things with a cash method. So there could be times when, and we'll discuss this, when you may be forced to use one or more a different method, such as an accrual method, as opposed to a cash method. So cash method. Most individuals and many sole proprietors with no inventory being one of those things that may force you to use an accrual method, use the cash method because they find it easier to keep cash method records. So that's the point of the cash method. The cash method is to say, hey, I know the audit trail for cash. I can see the cash going in and out, and that's easier for the IRS too. If everything's on the level and there's no difference between when earnings happen and cash, or they're fairly close in time, then cash is great because it's easy to see. It's easy to see what is happening. However, if an inventory is necessary to account for your income, you generally must use an accrual method of accounting for sales and purchases. So there's going to be one of the exceptions, right? If you have inventory, then you may have to use, or you will have to use an accrual method for the sales and purchases, unless you are a small business taxpayer defined later in this chapter. For more information, see inventories later. So you can check out more information on that if you're concerned that you'd rather be a cash basis, but you have the inventory. Income. Under the cash method, include in your gross income all items of income you actually or constructively receive during the tax year. If you receive property or services, you must include their fair market value in income. So obviously income, then, the difference between cash and accrual is when do you recognize the income and expenses. On a cash method, you do so when you get the cash. So when you get the money, then that's typically when you do, as opposed to when you did the work. Now, if you get something other than cash, it doesn't mean that you don't have to record cash and run a cash method because you got paid in some other format. Then you'd have to report it basically when you get the payment. Generally, would be consistent. So, constructive receipt. You have constructive receipt of income when an amount is credited to your account or made available to you without restriction. You do not need to have possession of it. If you authorize someone to be your agent and receive income for you, you are treated as having received it when your agent receives it. So in other words, you can imagine people trying to manipulate their income with the cash receipts. So for example, if I don't want to report the income, if someone didn't want to report income this year, they might say, oh, I'm on a cash method. How about I just have someone else collect all my receipts and I don't put them in the bank until next year? I didn't get the check. I didn't get the money. Well, your agent has the money. You have access to the money. So you have constructively received it, and therefore the IRS thinks that you should be reporting that on the tax return. And, if you don't open the mail and you have checks that are sitting there that you didn't put in the bank, well, then you've basically constructively received it. It's there. There's nothing restricting you from the cash. So the IRS would say, hey, we should get our share of that money as your silent partner. So cash method expenses. Under the cash method, you generally deduct expenses in the tax year in which you actually pay them. This includes business expenses for which you can test liability. However, you may not be able to deduct an expense paid in advance, or you may be required to capitalize certain costs as explained later under the uniform capitalization rules. So in other words, expenses then under a cash method would typically happen when you make the payment. Now again, the IRS is concerned about manipulation here with a cash method on when things are paid. So for example, if you're a taxpayer and you're saying, hey, I can write off something when I pay it, why don't I rent is my largest business expense? Why don't I basically just pay like 5 years of rent like today, and that'll take my net income down very low, and I won't owe any money on the taxes. I'll just prepay my rent right now and I'll get to deduct it. Well, the IRS is very skeptical of that kind of situation, right? Because you're basically using the cash method to manipulate actual income, and the IRS is going to say that they want, they should get their money on that. And the other thing is big purchases. Like we say, there's always going to be a deviation from cash when you have large purchases like property, plant, and equipment. So if you bought like a forklift or something for $100,000, then and you say, well, I paid cash for it, I'm going to deduct the whole $100,000. Well, no, the IRS says that's big purchase. It's going to benefit you a long time in the future. You basically have to use the accrual method in that case, put the forklift on the books, therefore as an asset, and depreciate it in accordance with the depreciation schedule. So those are kind of some deviations. And again, that second deviation with property, plant, and equipment is basically always a deviation, right? You pretty much always are going to deviate if you have a large difference between when the benefit happens and when the payment happens. And that's going to typically be the case when you're buying like a large piece of equipment or a building, even if you bought it with cash. Expenses paid in advance. You can deduct expenses you pay in advance only in the year to which it applies. Next, we have the accrual method, and this is kind of like the more proper accounting method if you're talking about financial accounting. And that's because you're basically recognizing things when they actually happen. Revenue when you did the work, not when you got paid, and the expenses when they were incurred, not necessarily when you paid them. There's a difference between those two things, although they can be happening at the same time. Under an accrual method of accounting, you generally report income in the year earned and deduct or capitalize expenses in the year incurred. The purpose of an accrual method of accounting is to match income and expenses in the correct year. So in other words, if you're looking at an accounting method and you're trying to match and you're trying to compare like one year to the other, then you really want to compare the earnings that you actually earn, not necessarily when you got paid for them, because otherwise the lining up of the earnings will not match from year over year, and you can manipulate the earnings. And on the expense side, same thing. I mean, if I'm paying my insurance expense all year for an entire year or 5 years today, then if I do a year over year comparison, it doesn't make sense, right? It's one year's gonna be outweighing the other year on the expenses because I happen to prepay 5 years worth of expenses. So on an accrual method, what you're trying to do is have a fair kind of ranking. If you're trying to compare one year to the other year and say what's fair for us to recognize if this year was better than the other year, An accrual method would be better at doing that than the cash method. Accrual method income. Under an accrual method, you generally include an amount in your gross income for the tax year in which all events that fix your right to receive the income have occurred, and you can determine the amount with reasonable accuracy. For a taxpayer with an applicable financial statement or other financial statement as the Secretary may specify, the all events test for an item of gross income is considered met no later than when taken into account in the applicable financial statement or such other financial statement. So again, typically when you're thinking about the financial statements, the financials are usually the best practice is an accrual method. People that learn it, when you learn accounting, of course, you typically are learning the accrual method of accounting. So accrual method expenses. Under the accrual method of accounting, you generally deduct or capitalize a business expense when both of the following apply. 1, the all events test has been met. The test has been met when all events have occurred that fix the fact of liability and the liability can be determined with reasonable accuracy. So you're basically looking at, and then let's see, the economic performance has occurred. So basically, the difference between the accrual and cash method is when you recognize the income and expenses, and on the expense side, you're looking to recognize them basically when they have incurred, when you've incurred them, when they've actually happened. So if you're talking about insurance, if you prepaid the insurance, the payment doesn't trigger it, the expense. What triggers the expense? When you've actually used up some of the insurance, when the coverage has been consumed and you've gotten use out of that through the coverage through that time period.